Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
All right, here we go. Last ICW of 2024. I want to thank our sponsor, FCT, for today's broadcast and really all year. Looks like Bank of Canada played Santa today, half a point decrease, which, again, Sherry Cooper predicted. So I think she's like 17 for 18 in a row, something around that. So good for you, Sherry. Congratulations on that streak. There she is. How are you?
Oh, good, Eddy. Thank you.
Yeah, it looks like Bank of Canada was not shy on another jumbo rate decrease. I think one that many predicted. I think most did, but you never know. And I think Friday's unemployment rate was probably what put them over the edge. What are your thoughts?
Yeah, exactly. That and just all the uncertainty, the notion that population is going to decline if the government does what it says it will, and I have some doubts about that, but we'll talk about it. And of course, all the uncertainty from Mr. Trump and his tariffs south of the border. They bought, I think, an insurance policy to keep the economy going. I don't think we're going to see another 50 basis point rate cut this cycle, barring a recession, which I don't think we're going to see. But
so you think little quarter ones, quarter point, and you're still predicting, going down to about 2.5 by sort of the spring, early summer.
Yes, and in fact, if anything, we might even see them go even lower next year.
Yeah, well, there you go. So lots of headwinds, and so that's good for interest rates, but we'll see what it does to the economy. Okay, before we get started, Sherry, just a reminder to everyone, if you have any questions or comments, please put them in your chat. We will get to them at the end of the presentation. And I think this is going to be a good one. Last one of the year, Sherry. You ready?
Yeah.
Let's do it. It's all yours.
Okay, so here we are, December, and as was widely expected, and Eddy mentioned, the Bank of Canada did it again and gave us another jumbo rate cut. Great news, overnight rate now at 3.25%. Just to put this in perspective, by the way, the Bank of Canada is by far the most aggressive central bank in the world as far as easing is concerned. They've taken interest rates down 5 times since June, and the last 2 times, of course, at a 50 basis point rate cut. And that is very good news for the economic outlook and certainly for housing. And I do think that we're going to see further rate cuts next year, but they made a comment, which they typically do, which is that each decision is made separately. and that it is data dependent. It will depend on what the incoming numbers suggest for Canada, as well as policy initiatives around the world, geopolitical developments, population changes, all of that. So let me proceed with looking first at the economy. The Canadian economy is growing, but at very modest levels. For this year, it looks like we'll see the overall 2024 GDP growth of a mere 1.3%. So well below the neutral rate of growth, potential growth, which is probably around 2 to 2.5%. So by that level, the bank it certainly has the ability to cut rates further, and I think we will certainly see that. Now, let's look at the growth pace. The last data that were released recently, about 10 days ago, showed that the third quarter GDP number was a mere 1.0%. The Bank of Canada forecasted to be 1.5%. It also looks like the fourth quarter growth rate is less than 2%. So those two things did combine to concern the Bank of Canada enough to go for another jumbo rate cut. We see a bounce up in growth in the first quarter, directly the result of fiscal stimulus. Some provinces, Ontario is one, as well as the federal government, are sending out Christmas bonus checks, at least for people making below a certain income threshold. And we've also got some GST cuts, depending on, those cuts may not be the full 13%. It depends on if the provinces are willing to give up their part of the sales tax. But the Bank of Canada suggested today that the combination of these factors may boost growth in the first quarter, but they don't see this having a major effect on inflation. There are offsetting influences to inflation, and so the bank felt comfortable in reducing interest rates by the full 50 basis points. You can see from this that there's a great disparity between what's going on in the United States versus Canada. U.S. economy is much stronger. U.S. inflation much higher. The inflation numbers that just came out this morning showed 2.7% inflation compared to 2% in Canada. And this stunning divergence between the U.S. and Canada is truly unprecedented in modern history. Just as an example, look at the difference in the U.S. in terms of mortgage debt servicing costs relative to disposable income. I mean, people who got a 2% mortgage back in 2021 or 2022 have locked that mortgage rate in for 30 years. So clearly with Canada and Canadian homeowners so heavily invested in variable rate loans, it's a very different story. And as a result, the Canadian economy is far more interest sensitive than the US economy, and hence the Bank of Canada has been far more aggressive than the Fed in cutting interest rates. The Fed will meet this week next week, and it's expected that they will cut rates, but only by 25 basis points. Well, since the last time we spoke on In Conversation with ICW, we had a US election, and this has been a Trump trifecta. By that, I mean Trump not only won the White House, but he's also got a small, but still a majority in the House of Representatives, and as well a Republican majority in the Senate. Very small differences, but makes a huge effect, and seismic shifts are coming. You can tell that already from the proposed candidates for different cabinet and other positions. The Trump government has long talked about tax cuts, tariffs, deporting illegal immigrants, deregulation. They don't like an independent Fed, although Trump himself has said that he will allow Jay Powell to stay on as the chair of the Federal Reserve through 2026, which is when his term would be up. None of us know that would be for sure, but Powell has said very overtly that he will not resign. So it certainly will be interesting times. The proposed tax cuts during the campaign, tax cutting season, it seemed like there was going to be a cut in tax, every kind of tax. They talked about extending the expiring tax reductions that were introduced in 2017 by Trump in his first term. Also talking about cutting corporate taxes, no tax on tips, on overtime or Social Security. All of that is just talk right now, but nevertheless, it can have an effect. The tariff situation has already caused major repercussions in Canada. Not only is Trump talking about 60% tariffs on China and 20% on all other countries, but as you all know, he threatened a 25% tariff on Mexican and Canadian exports to the U.S. as well. The immigration quotas, a massive deportation that's supposed to be happening, very disruptive, very expensive. That we'll just have to wait and see how it all shakes out. But also deregulation, the end of the antitrust push at the Security and Exchange Commission, and then, of course, the billionaires, both Musk and Ramaswamy, taking over a brand new department that hasn't even been created yet to reduce government spending and to reduce waste. So in the immediate aftermath of the Trump election, stocks just surged, but long-term borrowing costs moved up. Since then, of course, the dollar remains very strong. Budget deficits and inflation could well increase as a result of what's happening or likely to happen in the Trump government. And financial conditions have tightened. Long-term interest rates have retraced some of their gain earlier after the election. So going to the labor market, as Eddy mentioned, the labor market report last Friday really iced the cake on the 50 basis point cut in the policy rate. We saw the unemployment rate rise by 0.3 of a percentage point to 6.8%. So though we did see increasing job creation, 55,000 net new jobs created in the month of November. However, 90% of that was in the public sector. Private sector employment is lagging. And that certainly is one of the major factors that triggered the jumbo rate cut. Well, this shows you the unemployment rate moving up. The unemployment rate is at its highest level in many, many years. Before COVID, by the way, the unemployment rate was at 5.7%. So we've seen a full more than 100 basis point increase. So the working age population is growing much faster than job creation. On average over the last year, we've seen employment growth about 26,000 per month, but the labor force growth has averaged 125,000 per month. So hardest hit from an unemployment perspective are the new immigrants as well as youth, young people. The unemployment rate is double digit and rising very rapidly. One piece of good news in the labor force survey was a decline in wage inflation. We finally broken the trajectory of roughly 5% inflation. We're now down to 4.1%, still higher than what the Bank of Canada would like to see, but this is a lagging indicator. And as the inflation numbers continue to sustain at around 2%, as well, we should begin to see the wage inflation numbers declining even further. Job vacancies are back to where they were prior to the pandemic, and the job vacancy numbers declining have also been a disinflationary force in the economy. The latest data on inflation was for the month of October, and inflation came in at 2%, which is the target for the Bank of Canada, but it is up from what it was the month before as a direct result of the gasoline prices. Gasoline prices year over year edged upward, and that's mainly because they were so low 1 year ago. So we had that base effect. Now this shows you the inflation rate, and that 2% number followed the 1.6% the month before. Again, that was impacted by gasoline prices. And so this average of about 2% growth is what the bank would like to see. And we've certainly gotten there quickly, far quicker than the United States. This chart shows you the Bank of Canada's favorite measures for core inflation. Core inflation is running at about 2.6% as of October. And on a 3-month moving average basis, these numbers continue to trend downward. So the core measures continue to slow. This shows you the 3-month moving average. And if you exclude food, energy, and the sector that includes mortgage interest and the cost of rentals, the inflation number would be 1.8%. So again, the Bank of Canada feels confident that the pace of inflation is returning to target, and clearly they will continue to cut interest rates as we move forward. Only 38% of product prices now are rising more rapidly than 3%, so the breadth of inflation has also declined sharply. Again, more good news. So let's talk about what the Bank of Canada did. There were some economists that were warning them not to cut rates the full 50 basis points, that they might in fact be overstimulating the economy. I think that is incorrect. That monetary policy is still very restrictive. And in my view, further declines in rates are coming, taking the policy rate down from now 3.25% to about 2.5% by June of 2025. Now, this is why I'm saying that monetary policy remains restrictive. This shows the overnight rate, and currently having fallen to 3.25%, and the average measure of core inflation, which is just shy of 2%. Now, that means that real rates are in terms of the overnight policy rate, are 125 basis points. And that just means the nominal level of rates is 125 basis points above the rate of inflation. The the average for real rates over the past 30 years is 60 basis points. So again, monetary policy remains restrictive, unnecessarily slow, given the pressure, the pace of expansion in the economy, which is quite muted, particularly on a per capita basis. Now, every time the overnight rate goes down, so does the prime rate. So effective tomorrow, I'm expecting to see prime at 5.45%, which will reduce floating rate mortgage rates. Has a direct impact on monthly payments for those who have adjustable rate loans that adjust with every movement in the prime rate. For those that have variable rate loans, the actual monthly payment doesn't change, but the proportion going to principal rather than interest increases with the decline in mortgage, in the floating mortgage rate. So that's very good news. We've also seen that the spread between overnight rates in Canada and the United States continues. Canadian overnight rates now are about 125 basis points lower than US. That assumes that there's a 25 basis point rate cut next week by the Fed. So this is not without precedent. We saw back in the 90s when Canada was subject to IMF concerns about our fiscal instability as a result of very large debt and deficits federally. But other than that, this is really a very unusual situation that Canada has lower interest rates than the United States as a direct result of the underperformance of our economy. Now, this shows you a picture of the 5-year Government of Canada bond yield. It has gone down now, again, below 3%. It popped with the election because of concern about how stimulative the tax cuts will be by the Trump administration. But it is very good news because the fixed rate mortgage rates are tied to the 5-year yield. And so we had seen some of the banks raising their fixed mortgage rate in recent weeks following the election. There could likely be a reversal of that coming soon. But I guess what the markets are telling us is that they are expecting that the 5-year fixed yield has probably peaked and is not going to fall much further. Now, this shows you the decision dates by the Bank of Canada in 2025. So following today, the next meeting of the Bank of Canada is the end of January. I expect a 25 basis point rate cut in January, March, April, and that would take us to 2.5% by early June of next year. Now, I think that we could head even lower than 2.5%. Before the pandemic, the actual overnight rate was 1.75%. Now, I think that's lower than what we'll see, but could we get to 2.25% or 2%? Yes, I think we could. And again, it will depend on incoming data. This shows you the monthly seasonal patterns of home sales, and the rate cuts, particularly the large rate cuts on October 23rd and today, have accelerated the rebound in home sales that's typical during, as we move towards spring. Now, we're nowhere near spring yet. We haven't even started winter fully. So this is unusual, but there has already been a pickup in home sales in the month of October and November. Now, also very much relevant to what the Bank of Canada is doing and thinking is the payment shock, the renewals. Half of Canadian mortgages coming up for renewal in the next 2 years. You can see here the actual current mortgage rate versus the stress tested rate. And you can see that those people that are up for renewal did stress test their existing mortgages at 200 basis points over their contract rate, or 5.25%, whichever was higher. Well, given the plunge in interest rates we've seen thus far this year, it tells you that on average, the uptick in monthly mortgage payments, it will be sustainable by households because they did qualify at higher interest rates. Now, nobody wants to see their monthly payments increase, and the fact that we've had a full 100 basis point decline in the overnight rate just in the last couple of months will certainly be good news for people who are expecting renewal this coming year. So Canadian home sales surged in October, and the preliminary data for November thus far shows another big uptick, particularly on a year-over-year basis. So you can see this shows you the monthly average monthly home sales, and you see that in October the numbers ticked up sharply, now pretty much in line with the 10-year monthly moving average. It's been quite some time since we've been in line with that, so it's a precursor to what's to follow, with a very strong housing season this spring. Now, this shows you that this is the residential sales activity for the third quarter. Pretty flat, but up a little from the second quarter data. And new listings have increased sharply as potential sellers are finally coming to market. So we saw a surge in new listings in the third quarter. So sales to new listings have begun to edge upward. This is just the beginning. We'll see a lot more of this in the future. And thus far, home prices are stable. This is the smallest decline in prices since May we saw in October, but very flat line right now. With the pickup in activity coming as a result of the rate cuts, we will certainly see home prices begin to edge upward in all the major city centers. So mortgage originations, fixed versus variable. The times are changing pretty quickly. Right now, what we're seeing is that 50% of new mortgages have been borrowing in the 3 to 4 year fixed rate loan category. 23% are fixed and less than 3 years, and 10% are fixed 5 years or more. And variable rate mortgages originations are starting to pick up. So people want to take advantage of what will be additional rate cuts going forward, and that makes a comeback in the variable market. You can see that the fixed versus variable rate spreads have calmed down, and this shows you that 1 year from now, the markets are forecasting that the fixed mortgage rate will have declined further, but that beyond that, the level of fixed mortgage rates is pretty stable. So markets are predicting in 2 years' time that we see a further decline in the fixed rate. But by that time, it's going to be obvious that that variable rates have become considerably more attractive. So the housing shortage, big story in the housing shortage continues. But in fact, I believe that much of the Bank of Canada's reaction to inflation, the cutting of interest rates right now, is a direct result of this concern that we're never going to meet the needs of the rapidly rising population. This shows you working age population growth, and it is still very, very strong, even though the government has already announced cutbacks in temporary residents, and that would be cutbacks particularly in the number of foreign students, as well as temporary workers. This chart shows you the surge in the adult population and compared to the number of housing completions. It would take 500,000 housing completions per year to meet the surge in housing demand coming from immigration. And we've never seen that or even half that in any single year. So there was a growing awareness that there was no way to build our way out of the housing shortage. It just couldn't occur fast enough. And so as a direct result, the government in Ottawa has announced that it is targeting a slowdown in immigration. Now, this shows you that much of what's been built in the, over the course of many years has been in the multifamily space, and that has dwarfed the single family permits. The strongest sector in terms of sales are concerned has been in the single family sector more recently, as there seems to be a glut of condos available, certainly in Toronto as well as Vancouver. So housing starts are woefully inadequate. Even with today's stronger housing starts, we're still running at about the same level as we did back in the 1970s. So clearly, the population has nearly doubled since that time. This is just inadequate building. So let's talk more specifically about these immigration announcements, because they would have, if they were to be in fact realized, they would have a profound effect on the economy, because new Canadian residents do spend money, and even if it takes a while for them to get a job, they add to supply, but they also add to demand. So this shows you now what the revised planned permanent immigration levels are. They had forecasted a 500,000 target for next year and subsequent years, and they have now revised that down. So for next year, what they're saying is they're targeting 395,000. And by the way, only about 52,000 or between 52 and 58,000 of these planned permanent immigrants will come from the temporary immigration pool. So a big cut in these numbers, and these look at the permanent immigration. This is dwarfed by temporary workers. You see that this year the target was for 485,000 permanent new residents. That compares to 800,000 temporary workers and foreign students who were accepted in the year ending in 2023. And though we don't have the complete data yet for 2024, the numbers are almost as strong in 2024 as they were the year before. So a far cry from what the government is suggesting going forward. Now what it plans to do is to cut the number of temporary residents. The temporary residents in this chart are the yellow parts of the bar, and you see that they are sizable, much higher than permanent migration. And the temporary residents are foreign students, temporary workers, and asylum claimants. Now, what does that mean in terms of the actual intention? Ottawa plans to slash the number of temporary residents. Currently, temporary residents make up 7.2% of today's population. The government wants that to be 5% by 2026. So that means that 2.4 million non-permanent residents will have to leave in the next 2 years if they aren't granted permanent residency. 2.4 million. And remember, I had just said that only at most 58,000 will be considered from the pool of targeted permanent residents. So do we really believe that 2.4 million non-permanent residents will be forced out of the country in the next 2 years? It seems to me highly unlikely. They've already capped student permits at 364,000 a year, and that's down from 1 million foreign student permits issued last year. So that's astonishing, that kind of decline. Will we really do this? And what will the fallout be? What are the unintended consequences for all the universities that depend so heavily on the full tuition payments of foreign students? That's just one piece of the questions. There have been announcements recently that Sheridan College, for example, that had a large proportion of foreign students, is now suffering tremendous financial concern. So how is this all going to add up? I mean, it sounds like the federal government would like to see the kind of exodus of temporary workers that the Trump government is calling for in the United States. The numbers aren't as big, but given the percentage of our economy, of our population, the numbers are even bigger than the 10 million or 11 million illegal immigrants in the United States that will be sent back. Now, an estimated 1.26 million people right now have expired temporary residency permits for 2025. In other words, we know that 1.25 million people are going to be illegally within Canada as of next year. So what are we going to do about that? Well, mass deportations in Canada, I find this impossible to believe it will happen. And it's already very difficult to track down failed refugee claimants. Refugee Board already has 250,000 pending claims in the system. So imagine what happens next year when so many people are going to apply to the Refugee Board for asylum status. The law should be changed to issue removal orders automatically as soon as permits expire, but that has not happened. It would preclude migrants from becoming asylum seekers, but right now, 3,650 removal orders have been issued this year. So that number is going to increase very dramatically in 2025, 2026, if the government actually does crack down the way they say they will. But what about the labor shortages, particularly labor shortages in the trades and in healthcare? What about seasonal workers? Most of these will be temporary foreign workers hoping to become citizens. So again, the Bank of Canada was right in highlighting the importance of these major changes in immigration policy. And if they do come to fruition, the bank would have every reason to continue to cut interest rates to forestall what could be quite a meaningful further slowdown in the economy. So we also have a good deal of uncertainty in general. Look what immigration has done to rents in Canada. We know that the population boom has led to a big increase in rents across the country. And one question, if the government does what it wants, or what it says it wants, will we see a reversal in that? I find it hard to believe that this is going to happen, but there are major uncertainties going forward, and a very good reason why the Bank of Canada will make its decisions on monetary policy on a meeting by meeting basis. The biggest factor of uncertainty is, as Tiff Macklem said today in his press conference, is the big decline in Canadian population growth that's slated for the next 2 years. Another big factor of uncertainty is the threat of the 25% tariffs from the United States. And then we're going to have an economic update by Chrystia Freeland next week. And no question, she's going to tell us that they aren't going to meet their budget deficit targets for this year. They had said that the budget deficit would be no more than $41 billion, and it apparently will be substantially above that. And who knows, there is talk that she may also announce some further initiatives to boost housing and housing supply and housing affordability. But where they're going to get the money to pay for that is the big question, and that's part of the problem, in that you need higher interest rates if you're going to. Any kind of budget deficit increase implies more borrowing, which typically means more higher interest rates, not lower interest rates. So that is very much out of line with what the Bank of Canada has been suggesting. So I guess the last thing I want to say is that nobody knows how this will shake out. And therefore, there's a good deal of uncertainty, complexity, ambiguity going forward. But for sure, the bank did the right thing today, and it will boost housing, as we've already seen it happen. Thank you, Eddie. That completes my formal remarks.
Awesome, Sherry. Thank you. We have some questions. As you went through your presentation, the things that stood out to me were glaring. Was one, that you mentioned the Q1 GDP, or the latest Q1 is 1%, and then it goes all the way to 2.8%. And you're saying that's going to be a stimulus. Well, that is a huge increase in just a couple of quarters.
Yeah, that 1% figure is well below what the bank had imagined it would be. And clearly, if we do get those bonus checks and people spend the money, there will be stimulus in the first quarter. That doesn't necessarily mean it actually will be 2.8%, but the GDP quarterly numbers are a volatile series, and you do get big swings from quarter to quarter.
No, that makes sense. Okay, let's get to some questions. Ashley Fresca asks, is BOC, Bank of Canada, acting more aggressive compared to other central banks in their rate cuts due to the higher debt levels here, especially in BC?
No, we don't have the highest debt levels at all. I mean, yes, they're too high, but in comparison to the other countries, our debt to GDP ratios are really not that terrible.
And then U.S. is worse than us, and their rates are better. So that would be an example that's that kind of contradicts your comment. Okay, so next one is from our friend Jay Nugent, not Jason today. It's Jay Nugent. We heard some talk that due to the strong U.S. economy and weaker Canadian economy, we could say Canadian bond rates rise next year to try to attract investors. What are your thoughts? Interesting enough, you had the bond rates kind of go back up over time. Is that because of investors or other reasons?
No, I didn't have a forecast for bond rates. I just showed you the actual bond rates. They were historical. They moved up in the immediate aftermath of the election because Trump is seen to generate higher budget deficits than Harris might have. But Jason, the higher interest rates would never be introduced just to attract investors, because higher interest rates slow the economy. And so the Fed is, and the Bank of Canada for sure wants to see lower rates going forward, because they want to see inflation at the 2% target, which for Canada, we've already achieved that. Now, what would give us higher rates? Well, if inflation were to reverse and move up, rates would rise. But that's unmitigatedly bad news. If the economy were to be much stronger than we're expecting, rates would rise. But if we do slow population growth, and particularly if it turns negative, which is what the federal government is forecasting, there's no way we could see higher interest rates, because the economy would languish as a result, if it really does happen.
Okay, so you talked about the tariffs and that it could be affecting our economy. So Mortgages by Mark asks, BMO published a recent report suggesting that if the tariffs come into play, the Bank of Canada may cut rates an additional 1%, bringing the target rate around 1.75. What are your thoughts?
Well, again, that's a possibility. The overnight rate was 1.75% before COVID, and the economy at that time, inflation was even below 2%. The economy was running at a relatively strong growth pace. So it's possible, but again, let's hope not, because it would require, real collapse in economic activity to get rates down that much more. And we don't know, the last time Trump was president, he did introduce tariffs on some Canadian products, and we actually increased tariffs on US products. And given that we import our budget, we have a trade deficit with the US, so we obviously import a fair bit, but we're not, the US is our number one trading partner. We are not the US's number one trading partner, we're number 3. So we can retaliate, and that may reduce the chances of a sustained 25% tariff. But again, it's going to have a much smaller impact on the US than it would have on Canada. And so we don't have great bargaining chips in this.
Yeah, so we were at 1.75 pre-pandemic. I don't remember any crazy economic conditions that would bring us that low. Do you remember like what was happening before the pandemic?
Well, there were deflationary forces.
There was, okay, yeah, okay.
Inflation averaged less than 2% for the prior 10 years.
Was that the time that some countries had negative rates?
Yes.
Yeah, okay, yes. It was a long time ago. I remember that was a big topic of conversation. The whole idea of somebody paying you to borrow. I don't know if we'll get to that anytime soon, but next question is from Nina Parma. what is Canada doing to attract more investors to Canada with rates have that effect? Will rates have that effect? So,
it's interesting because we've done the opposite when it comes to investing in housing. We've made it more expensive for foreigners to buy because of vacant property taxation. So, we have, my point of view, in a misguided effort to make housing affordable, we've taken actions that will reduce the demand for housing in Canada. And obviously, from our own interests, personal, business interests, that's not favorable. But it certainly is. It hasn't been successful in improving affordability.
Unintended consequences, right? I want to talk about renewals because that has been in the news quite a bit. 1.2 million Canadians will renew next year. There's talk about a possible, they call it payment shock, or payments that are going to be more than what they were previously. I just wanted to remind everyone that you want to talk to a mortgage broker. It's really important to talk to a mortgage professional going through your renewal process. You will get something from your existing lender. That will be probably a piece of paper or maybe even a phone call talking about your renewal. You want to keep them honest. And the best way to do that is talk to a mortgage professional. Here at DLC, we've helped thousands of Canadians throughout their renewal process, and we want to help you. The best way to get a hold of a DLC mortgage broker is through our website, www.dominionlending.ca. Go through that, do yourself a favor, and get certainty on what is going to happen with your renewal, and we can help you do that. You can book a free mortgage renewal review with one of our mortgage professionals, and they will help you navigate that renewal. Really important, guys, that you do that. One of the things that we are working on really diligently here at DLC is ensuring that we can give you proper advice. You heard Sherry talk about fixed versus variable. These are questions that you need to ask. Don't just renew, ask the questions, and we can help you navigate that renewal. Any comments on that, Sherry?
Well, again, it's a real opportunity for the mortgage brokers as well, because it gives them the impetus to go through their customer relations software and figure out who is, what prior customers you have that are coming up to a renewal period and will need to be making decisions. And they need choices. They need the options. It needs to be explained what, in fact, the array of possibilities are. And I'm sure it would bring a good deal of comfort to people because nobody likes uncertainty.
Yeah, a great message for the mortgage brokers watching today. Communicating with your database, communicating with your clients is so important. As you know, we've been talking about Gold Rush. This will give you an edge. You'll ensure that you are firing all of those messages to the right clients at the right time. If you want to inquire about Gold Rush or inquire about how you can be contacting your clients, especially that renewal client, give me a call personally. Email me at eddy@dlc.ca. That's eddy@dlc.ca, and I'll ensure that you have that. Really important. The next year is going to be a huge renewal year. Your clients are going to want to hear from you. They're going to want that advice. So ensure that you contact me to get that Gold Rush firing. I got another question here from Carlos Lerma. Hey, Sherry and Eddy, thank you for your insights. You're welcome, Carlos. It is correct to assume that rates are going down because economy is not doing as expected. Well, there is a correlation, but I'll let you answer that, Sherry.
Yeah, rates are going down because rates have gone up too much. It's like they raised rates like crazy, remember, to fight inflation. Inflation is coming down. Inflation in Canada has come down rapidly. And on top of that, our unemployment rate is rising. Our economic growth numbers are certainly aren't stellar. And we'd like to see more non-inflationary growth. So they're normalizing interest rates, really. They're reversing the easing, the pandemic easing. And, you know, we don't have pandemic anymore, so we don't need sky high interest rates. And as a result, you know, we've finally broken the back of inflation, in my view. And so here we go with, you know, whatever normal rates will be. Now, you'll hear economists talking about the potential normal kind of range of interest rates, the neutral monetary policy, neutral interest rates. Neutral meaning that they're not expansionary, but they're not contractionary. They are consistent with full employment, potential growth in the economy, with inflation no more than 2%. And the bank estimates that level of interest rates is somewhere between 2.25% and 3.25%. Now we've got the overnight rate at 3.25%. So we're at the top of the neutral range. I've showed you why I believe that monetary policy is not neutral right now. It's actually restrictive. And so we need to get real rates down. And in my view, another 75 basis points at least. So that's 3/4 point rate cuts. And I think we'll get them early next year.
We could use a little bit of boring, eh, Sherry? Like, you know, a little bit of boring would be really good right now. It's these extremes, and you know, and the government, of course, what they want to do is get to that neutral place. I mean, they're working hard to get there, and they have to do it with a fine balance act. I am not envious of what the Bank of Canada has to do that, but they do overshoot, and they probably overshot the one way during the pandemic and went too low. Then they overshot the other way when the pandemic was over, and they're trying to, you know, calm or slow things down. And will they think they'll overshoot again? Probably. I don't know. What are your thoughts?
Well, it's certainly typical. And I think it's good news that we will see interest rates further declining. It's good news that activity in the housing market will pick up. And Canada's got an unusual situation in that we have a very concentrated population base, and the influx of new immigrants to our major cities has been overwhelming in terms of not just in terms of home prices and rents going sky high, but also in terms of the pressure it's put on our public services. Healthcare is a great example. They're just, you know, our systems are just not adequate to handle this enormous influx of people that has taken our population to well over 40 million. And it happened very quickly, and it happened without any real planning about where these people were going to live. And so the government now recognizes it, and they say they're going to do what would be very dramatic things to get the population back to where they think it's sustainable. But who knows whether they actually will pull this off.
Well, one thing I know about Canadians is they want to buy homes. They use their homes very well in terms of refinancing so they can invest, you know, help with family, etc. It's a great time to ensure that you are firing on all cylinders, getting ready for what's to come. We all are predicting the same things. There is tailwinds. You got policy changes that are going to be very helpful in housing. We have lower interest rates today, another 0.5 point, and you hear Sherry Cooper to go to 2.5 by June. We have pent-up demand. We have high immigration, all the variables to make next year a really good year for housing and mortgages. We're excited about it. I hope you are too. I wanted to say on behalf of Sherry and I, for all of you, have a great holiday. For those of you that are celebrating, celebrate safe, and all the best to you and your families. We really appreciate you joining us at ICW for 2024. I think 2025 is just going to be as exciting. What do you think, Sherry? I don't see it as being boring.
No question.
Definitely won't be boring. But again, on behalf of Sherry, DLCG, and FCT, we really appreciate you. And until next year, take care, everyone. Bye-bye.
Bye-bye.